If you just turned 65 or someone you love is about to this year, don't close this video yet. Right now, at this very moment, there are 3 separate places quietly taking money out of your pocket. Your bank won't tell you. The tax office won't tell you. No one will. Stay with me until the end, because the most important part comes last. 3 quiet ways the system keeps charging you for things you stopped owing years ago. Then I will give you 5 solutions, 5 clean, simple moves that protect the money you worked a lifetime to build without putting it at risk and without making you learn anything complicated. The IRS will not tell you this. Your bank will not tell you this. The county clerk will not either. Stay with me to the very end, because the best part is at the end, and most people are never told this for free. Before we go any further, let me set your mind at ease about one thing. I am not selling anything. I am not here to make you afraid.
I am a retired fellow sitting at a kitchen table putting on paper exactly what I wish someone had sat down and told me at 65. Everything I say is grounded in real federal law, real recent numbers, and real things you can look up today. If I get one number wrong, I will correct it. Let me earn your trust by being careful. And let me show you where the money is hiding so you can go quietly get it. Here is the first danger, and it surprises almost everyone I sit down with. The IRS quietly keeps collecting taxes from you long after you have earned the right to stop paying them. I am not talking about anything illegal. I am talking about legal breaks written right into federal tax law that almost nobody over 65 ever claims because nobody ever told them the boxes existed. The mechanism is simple, so let me walk you through it slowly. When you file your federal income tax return, the IRS gives you 2 ways to lower your tax bill. The first is the standard deduction, which is a flat dollar amount the IRS subtracts from your income before it computes your tax. The second is itemized deductions, where you list things like medical bills, charitable donations, and mortgage interest. For people over 65, there is an extra amount sitting right there on the page, hidden in plain sight. It is called the additional standard deduction. On the most recent tax form, it quietly added about $1,950 per qualifying person if you are married filing jointly, or about $1,550 if you are filing single. If both you and your spouse are 65 or older, that combined married amount is roughly $3,900 a year, sitting in a place the IRS will not put onto your return unless somebody checks the boxes on the form. That is on top of a second break that almost no one uses. The IRS lets you deduct medical costs that go above 7.5% of your adjusted gross income. Adjusted gross income is the income number on your return before the standard deduction is taken. Most retirees never claim this because they assume their medical costs are too small or because they never bothered to keep the receipts. But for a typical older couple on Social Security, Medicare premiums, supplemental insurance, prescription drugs, dental work, hearing aids, eyeglasses, and regular doctor visits add up fast. They almost always push you across the 7.5% line. If they do, every dollar above that line is a dollar the IRS no longer has the right to bill you for. And there is a third break most folks have never heard anyone mention. The age at which the IRS forces you to start pulling money out of your traditional retirement accounts, what they call required minimum distributions, or RMDs, has moved. It used to be 70.5, then 72. Right now, in late 2025, the age is 73. Soon, it will rise again to 75. That means you have 8 more years between 65 and 73 years. The IRS is no longer reaching into your retirement account and demanding a slice each year. Your money can keep sitting in there, growing tax-deferred, untouched. Here is the anchor I want you to hold. Look up IRS Publication 554, called The Tax Guide for Seniors. It is free. It is on the IRS website at irs.gov. It lays out every break I just mentioned in plain English. The IRS wrote this guide. They consider it official instruction. They will not mail it to your door, and they will not call to walk you through it. So the IRS is not your enemy here. They are not hiding anything, but they are enormous. They process over 150 million individual returns a year. They do not have time to call every senior and say, "Hey, by the way, you stopped owing us $3,900 last year." Do not just do nothing about this. Pick up the phone, talk to a tax preparer, ideally one who specializes in senior returns, or do your own return. Either way, check the senior boxes on the form. They are on the form for a reason. Now, here is the second danger, and this one is sneaky because the money is leaving your account in tiny, quiet amounts that you almost never notice. Your bank keeps charging you fees that are legally supposed to be waived the moment you turn 65, and your bank is not going to tell you. The mechanism here is the monthly maintenance fee. Almost every big retail bank has one. If you walk into a Chase branch, a Bank of America branch, a Wells Fargo branch, or any of the regional banks like PNC, TD Bank, US Bank, Regions, or Fifth Third, you will find a basic checking account that costs somewhere between $10 and $15 a month just for the privilege of holding your money there. That is $120 to $180 a year walking out the door. The bank tries to make it feel normal. They call it a service fee. They put it on your monthly statement in small print. They do not put a red flag next to it. They just let it slide month after month for as long as you are willing to pay it. Here is the part they do not tell you at the teller window. The same bank has somewhere in its own paperwork a clause that waives that fee for customers who are 65 or older and meet a small set of quiet conditions. Some banks waive the fee for any senior account holder with no minimum balance requirement at all. Others waive it as long as you have direct deposit of your Social Security or your pension. A few will waive it if you simply ask. The conditions are not hard. They are tiny, but the bank will not volunteer them. They will not print it on a poster in the lobby. They will not mention it when you open the account. They will let you pay $10 or $15 a month for years, because to them, that is $1,000 of free revenue from a customer who never bothered to ask for the waiver. I want to give you an anchor here. In 2023, 3 big American banks failed within weeks of each other. Silicon Valley Bank in March, Signature Bank in March, First Republic Bank in May. The Federal Deposit Insurance Corporation, which is FDIC, the government agency that protects money in bank accounts, ended up paying out insured deposits to over 500,000 customers across those 3 banks, about $162 billion in total. After that, every big bank in America quietly tightened its rules on what kinds of accounts it will keep open, especially for older customers with steady balances. Some banks are now closing long-standing senior accounts altogether. If the balance drifts below a certain number, they mail a letter. They give you 30 or 60 days to move your money. They do not really explain why on the letter. The underlying reason is that your quiet $12 a month is no longer worth as much to them as it used to be. And so, please do not just do nothing about this. Walk into your bank branch this month. Bring a piece of mail that proves your age. Bring your Social Security award letter if you have it. Sit down with someone and say the words, "Do I qualify for a senior fee waiver?" The person behind the counter has the form. They have probably waived this fee 100 times. They are waiting for you to ask. And here is the third danger. And this one lives in your mailbox once or twice a year in a thick envelope from your county that you have probably been paying without really looking at it. Your state and your county quietly keep billing you for property taxes that have a senior exemption built right in. An exemption you almost certainly never applied for. The mechanism is this. Almost every state in America has some form of property tax relief for people over 65. Some states freeze the taxable value of your home the year you turn 65. So even as your house keeps rising in market value, your tax bill stays flat. Some states take a flat amount, often anywhere from $25,000 to $75,000 off the assessed value of your home before they compute your tax. Some states let seniors defer the entire property tax bill until the home is sold, as a quiet lien against the property. A small number of states offer outright homestead exemptions, where the state actually sends a real check back to you. Every one of these programs is real. Every one of them is written into state law. Almost none of them is automatic. Here is the part your county clerk will not call you up to explain. In most places, the senior property tax exemption is something you must apply for. There is a form. There is usually a deadline, often in the early part of the calendar year.
You have to bring proof of your age, proof that you own the home, and proof that you live in it as your main residence. The clerk's office will accept the form. They will smile. They will process it, and starting with your very next bill, the exemption will quietly subtract thousands of dollars from what your county is allowed to bill you. But the clerk's office processes hundreds of thousands of bills a year. They do not have the staff to call every senior homeowner and say, "Hey, did you know this was sitting on the table for you?" So, they just mail the full bill. They collect the full bill, and the senior pays the full bill year after year because nobody ever said the words, "Do I qualify for the senior exemption? And what is the deadline?" Here is the anchor I want you to hold. Search your state's name along with the words Senior Property Tax Exemption. The first result is usually the official state website. For example, in Florida, the homestead senior exemption is $50,000 off the assessed value for any owner 65 or older. In Pennsylvania, the Senior Real Estate Tax Rebate Program can send a check of up to $1,000 a year. In Texas, the homestead exemption for those over 65 freezes the school district portion of your property tax at the prior year amount. In New York, the enhanced star exemption reduces the taxable value of a senior's home by tens of thousands of dollars each year. Each one is a real program. Each one has paperwork. Each one has money on the table for you. Some of you will say, "My state does not have that." Maybe not, but your city or your county might. If your search comes up empty, call the county assessor's office. 2 questions is all it takes. Ask, "Do you have a senior exemption?" And ask, "What is the deadline?" Do not just do nothing about this. The bill in your mailbox is real. The exemption is real. The only thing standing between you and the savings is one short phone call. So now you understand the 3 dangers. The IRS keeps collecting taxes for breaks you never claimed. Your bank keeps taking the small monthly fee you could have waived. Your county keeps mailing the full property tax bill when the senior exemption is sitting right there on the shelf. The pattern is the same. Large institutions, with very small reasons to call you up and point it out, quietly billing you for things you no longer owe. That brings us to the question you have probably been waiting for. How much is too much to keep in a regular checking account? The honest answer is more than $15,000 to $25,000. That is roughly 3 to 6 months of regular living expenses for a typical retiree, covering food, utilities, medicine, and a few modest extras. Anything above that range should not be sitting in that one checking account, because at that size, 3 things start happening at once. The bank starts tracking it differently. The FDIC, the government agency that protects money in bank accounts, only protects up to $250,000 per depositor per bank, so anything above that line goes unprotected in the event of a quiet failure. And the checking account earns next to nothing, often less than half of 1% interest, while the cost of living keeps rising at around 3% a year, which means the money in that account is slowly shrinking in real buying power every month, even though the number on the screen stays the same. That is where the 5 solutions come in. Let me walk you through them one at a time in plain language. Number 1. Move the overflow into a high-yield savings account at an online bank. A high-yield savings account is just a regular savings account that pays you real interest instead of almost nothing, and it is offered by banks that do not have expensive branches to maintain, so they pass the savings on to you in the form of higher interest. Most of the well-known online banks right now are paying somewhere around 4 to 4.5% annual interest on savings. That is not a teaser rate that disappears in 6 months. That is the published rate sitting right on their account page. Compare that to the typical big retail bank checking account, which pays essentially 0, often less than half of 1%, and which charges the monthly maintenance fee we just covered. The 4% is real money on $20,000 parked safely in a high-yield savings account that is about $800 a year paid into your account monthly, federally insured up to the FDIC limit, with your money staying liquid. Liquid means you can move it back to your checking account in 2 or 3 business days if you need it. The honest trade-off is that you cannot walk into a branch. You do everything online or through an app, and transfers from the high-yield account into your regular checking account usually take a day or 2. So, this is not where you keep the bills you pay next week. This is where you keep the money you do not need for 90 days or more. Number 2, latter part of your cash into US Treasury bills bought directly from the federal government through a website called Treasury Direct, which is a free government site that lets you buy Treasury bills without a broker and without paying a commission. A Treasury bill, often shortened to T-bill, is just a short-term loan you make to the United States government. They pay you back with interest in a few weeks or a few months. The United States has never missed a payment. That is not a sales pitch. It is the factual history of every T-bill the government has issued since the program began more than 60 years ago. Right now, in late 2025, Treasury bills are yielding somewhere around 4 to 4.5%, depending on the term you choose. Here is the bigger benefit most retirees never hear about. The interest you earn on a T-bill is free from state and local income tax. Federal income tax still applies at ordinary rates. But if you live in a state like California, New York, New Jersey, or any state with its own income tax, that state tax-free piece can be worth an extra 1 to 3% of your yield compared to a regular bank account on $50,000. That is real money walking back into your pocket each year. The honest trade-off is that Treasury bills come in fixed terms. A 4-week T-bill, a 13-week T-bill, a 26-week T-bill, a 52-week T-bill. If you need the money before the term ends, you have to sell it on the open market, and the price can move against you. So this is where you keep money you are confident you will not need for at least 3 months. Number 3. Look seriously at Series 1 savings bonds. A Series 1 savings bond, often just called an I-bond, is a special savings bond the United States government issues that keeps up with inflation. Twice a year, in May and in November, the Treasury resets the interest rate based on the official inflation numbers. When inflation goes up, your I-bond rate goes up. When inflation goes down, your I-bond rate goes down, but it never falls below 0. You will never lose money on an I-bond. Right now, the composite rate on I-bonds, which combines the fixed part and the inflation part, is somewhere in the range of 3.12 to 4.5%, depending on when it was purchased. The exact number changes every 6 months, so look up the current rate at Treasury Direct before you buy. That rate is real and verifiable on the Treasury Direct site itself. There are 2 honest trade-offs to know. First, there is a hard purchase cap. The government limits you to $10,000 per person per calendar year. That is per Social Security number. So a married couple can put in $20,000 a year between them. Second, if you sell the bond before you have held it for 12 months, you lose the last 3 months of interest as a small penalty. After 12 months, you can sell anytime with no penalty. So treat I-bonds like a 1-year plus parking spot for some of your savings, especially the savings you would like to see grow with inflation rather than get quietly eaten by it. Number 4. If you have a lump sum you do not need to touch for 1 to 5 years, consider brokered certificates of deposit purchased through a brokerage account. A brokered CD is just a regular bank CD, which means a certificate the bank issues that pays you a fixed interest rate for a fixed term, except you buy it through a brokerage firm online instead of walking into a branch. Why does that matter? Because a brokerage firm can split one large purchase into pieces of $100,000, $200,000, or $500,000 and place each piece at a different bank. Each piece sits at one bank, fully FDIC insured, up to the $250,000 limit per depositor per bank. But the whole pile of money is now spread across many banks, so no single bank failure can sweep it all away. That is the structural fix for the FDIC danger we covered earlier. You can put $1 million to work this way and sleep well because each piece is independently insured. The honest trade-off is that brokered CDs are not liquid. If you need the money mid-term, you have to sell the CD on the brokerage's marketplace and the price can move against you. So, this is for money you actually do not need for the full term of the CD, often 1 to 5 years. And the yields on brokered CDs right now are competitive with Treasury bills for the same term, often around 4 to 5%, sometimes slightly higher for longer commitments. Number 5. Open a money market fund inside a brokerage account and keep part of your safe cash there. A money market fund is a pooled investment account that holds short-term government and corporate debt, and it behaves almost exactly like a checking account. You can usually write checks against it. You can usually transfer out in a day. and the value of your share never wavers by more than a fraction of a penny. The difference is the yield. Right now, top money market funds are paying somewhere around 4 to 4.5%, comparable to the best high-yield savings. Here is the honest part. A money market fund is not FDIC insured. It is not a bank deposit. It is a fund held by a brokerage firm, governed by Securities and Exchange Commission rules, and protected by strict rules requiring the fund to invest only in short-term, high-quality debt. If something truly catastrophic happened, you could lose a fraction of a cent per share. In the real history of money market funds in the United States, that has happened only twice in very unusual circumstances. The yield you earn is the trade-off for accepting that tiny, tiny risk, which is much smaller than the real risk of leaving too much in one checking account earning nothing, while inflation runs around 3% a year. The honest trade-off on the other side is that this is a brokerage account, not a bank account. There is no FDIC insurance. There is no branch to walk into. You do everything on a website or an app. But for the cash, you want to keep earning real interest while still being essentially spendable within a day or two. This is one of the cleanest tools sitting on the table. Let me tie all of this back together because there is a single thread running through every danger and every solution, and I want you to see it clearly. The current system quietly takes from you through 3 channels at once. Watching that is the IRS, keeping its eye on what you owe and on what you have not claimed. Shrinking, that is your bank slowly skimming fees when it should not be, and inflation slowly eating the value of cash that just sits there and unprotecting. That is having more than the FDIC limit parked in one place, where one quiet bank failure, exactly like the kind we saw in 2023, could sweep it all away overnight. When you make the 5 moves I just walked you through, you are not putting your money at risk. You are removing risk that was already sitting there. You are turning a near-zero checking account into 4% plus cash sitting across several safe instruments. You are turning an unclaimed senior tax break into real money back in your pocket. You are turning a waivable bank fee into a clean 0 on your monthly statement. You are turning an unpaid property tax exemption into a smaller county bill every year. You are not gambling. You are not chasing yield. You are removing silent drains that were already pulling from your account and putting each dollar in the place where it earns the most while being exposed to the least.